Chris, welcome back to the show. It's been a while.
Yeah, good to see you, Dan.
Uh, just so our listeners know, Chris and I see each other once a year at Value X Vail. So um, he's a diehard value investor, and I strongly encourage you to go to his website, broyhillasset.com. There's lots of great stuff there, and we'll talk about some of it today. But first, the question I like to ask you in particular, you are a voracious reader, and I want to know what you've been reading lately that you might like to tell us about.
Yeah, I would. So good start. You know, we always like to talk about about books.
Yep.
Um, I'd say the most recent thing that jumps out, and something that I shared with the rest of the team, was a book titled "Unreasonable Hospitality." And so it was written by the manager of 11 Madison Park, which at some point in the last several years was ranked the number one restaurant in the world. Um, we don't have any investments in the restaurant industry, but like most investors, like we are in the client service industry, and so it's just super interesting to watch and learn about sort of how they approached hospitality and what made them different and stand out. And I think what took me there initially was I saw the book being held in an episode of The Bear. I don't know if you guys are a fan of that on Hulu. It's I think one of the top shows on television, but it's about a Michelin star chef that winds up back in Chicago at an Italian beef shop, and transforms that into another Michelin star restaurant in Chicago. And in the kitchen, they were holding a copy of this book. So yeah, definitely worth a read for anybody that is in any type of client service industry. And then I guess I should maybe share one more that's slightly more investment or at least analytical oriented. A friend of mine referred me to Fermat's Enigma, which I've read earlier this year. It's just this fascinating story of, and this was actually made into a documentary as well. It's this fascinating story of a modern mathematician that solved a 350-year puzzle that had stumped experts for centuries. So it's just this, wonderful novel that reads like almost like science fiction, combining, math, perseverance, and just, intellectual curiosity and adventure. And so I've gone on to read just about everything that the author had written.
Yeah.
Um,
Simon Singh.
the
Yep.
Yeah, yeah, and the other one I'll call out, which was a lot of fun. He wrote a book called The Simpsons and Their Mathematical Secrets. So I had never realized. I mean, obviously the Simpsons are highly intelligent and ahead of their time, but there are 7 writers on The Simpsons with advanced degrees in either mathematics, physics, or science, or some sort of scientific field. And it's just amazing how much they've kind of weaved into different episodes over the years where
Yeah.
unless you're a mathematical genius, you probably totally missed the joke. But it's just, yeah.
All right. Well, as you were talking, I'm adding all these to my Amazon card. So,
Good. You got any for me, Dan?
actually, the latest thing that I really dove into and read cover to cover was NATO: What You Need to Know. It's a short book about um, NATO's eastward expansion in Europe and how, and it also suggests maybe NATO shouldn't even exist anymore because it was there to sort of guard Europe against the Soviet Union. So it's like, why is it still around? Um, and it paints a grim picture of NATO as a kind of warmongering organization. So, but it's a short read. I think it's like
Interesting.
200 pages. Yeah. Um, so reading a little bit about war here and there, um, and just came across that. But otherwise, like the one that I recently started, we interviewed a guy named Brody Mullins, and he wrote a book called The Wolves
Okay.
of K Street, which
Okay.
and he's like born and raised in Washington D.C. and doesn't like think or talk like a swamp rat. So I was like, I didn't know him before we interviewed him, and and during the interview, I was like, wow, I like this guy. So we're going to we invited him to do an onstage sort of fireside chat with me at our Vegas conference in Las Vegas in about a month or so here, um, and uh, and I'm going to read it. You know, I'm going to get through this book. I'm going to read every word of it in preparation for
Yeah,
that.
Dan, I'm still on that one on
Well,
Audible. I'm listening to that one, so as well. Yeah.
Oh, cool, great. So that's what I got recently here.
add them to the list.
Yeah.
Thanks.
So I did mention that you have a really good website. Like nobody could go to your website and spend a decent amount of time and come away not knowing like what kind of investor you are. Um, but rather than tell people to turn the podcast off and go to the website, maybe we'll just get you to kind of fill in some of those blanks. And you know, if you and I just met and I said, "What kind of investor are you? What kind of investor is Broyhill, you know, asset management?"
Yeah.
What,
Well, first of all, appreciate the feedback. That probably came through on the site. It probably doesn't look like most, investment manager websites. I think we've got most of the investment team at the firm has a unique blend of backgrounds across the arts and sciences, including my own, which is why we kind of tried to make that shine through really on the site. Um,
Wait a
so
minute,
I
are
can
you the
start with
architect in the group?
I,
Do I
I
remember?
I am,
Yes,
or at least I wanted to be at one point in time.
right,
So I initially went into school as an architecture major and came out with a finance degree, but
right. I thought so.
that's driving a lot of the design you see on the site. Why don't I start? I'll start with the family office itself, which predates my involvement. Broyhill Family Office was founded in 1980 after the sale of Broyhill Furniture Industries. So the office has been around for about a half a century at this point. I joined in '05, which I guess makes it nearly 20 years that I've worked for one family, which is kind of hard to believe. Initially as a PM on one of the family's internal equity strategies, then as the family's chief investment officer, and now as the president and chief investment officer of Broyhill Asset Management, or BAM. So BAM spun out of the family office in just the past couple of years.
Hmm.
Independent entity today, we still manage money for the family in addition to other families, foundations, institutional investors, high net worth investors. I think of ourselves, and we've always thought of ourselves as a value-driven investment boutique. So, per your opening comments, I think what differentiates Broyhill is our almost obsession and focus on capital preservation. Um, the way I put it, I'm basically paid to worry so that our investors don't have to. Um, the core of what we do has been the same for as long as I've been here. We run a concentrated portfolio of global equities, and we do that with, or we try to do that most of the time with a rational, objective, and long-term perspective. And I would just say, in a nutshell, right at the end of the day, we're just looking for mispriced securities.
Hmm.
And we go wherever we see them or wherever we think we're going to find them.
How concentrated are we talking?
We generally run with 10 to 20 names. I think over the years, I've figured that out using a scientific process called the sleep at night factor. If I get close to 10 names, I start losing sleep because I feel like we're a little bit over concentrated. And yeah, one wrong move can cost a lot. Once we start pushing up against 20 names, I start losing sleep again because I feel like we're not as close to each of our investments as I should be. And so we're typically, we're probably around 16 today. So we're kind of right in the sweet spot.
How many people are at Broyhill now?
So the investment team is myself, and we've got three other analysts on the investment team. And then we've got our chief of staff. We've got one gentleman that runs operations. And then we are currently in the process, or at least considering adding one more analyst to the team. And I think that's probably about it, Dan. I don't, you know me, I don't, I think I'm a better manager of money than I am of people. And so, yeah, we want to keep this small. We want to keep having fun. I think, culture is tremendously important to us. And so, just making sure we're working with the right people, both in terms of colleagues at the firm and investors. That's first and foremost.
How about firm size? Is that something you discuss in public or no? Like
Um, so
AUM.
we've,
Sorry.
yeah, we're somewhere, let's say between 250, 300 million today.
That's a nice business. That's nice. Um, and at this point, like, are you still mostly like working for the family, or is the balance of the assets, more with other clients?
Yeah, I was fortunate, we began managing some external capital even while I was still inside of the family office. And
Hmm.
so when we spun out the investment arm, it's not like we started day one with one large investor. When we spun out, the asset base was probably 50-50 in terms of Broyhill family capital and external capital. Today, we're probably closer to two-thirds, one-third.
Hmm.
So again, there's that sleep at night factor in terms of having a little bit more diversification in the client base as well, which I think is a good thing.
So tell me the one of the things that fascinates me with money management firms, especially value investors who have been value investors for a long time. I guess the basic question is, how do you keep your clients? And I'll tell you specifically, I'm asking this question because I came across an old interview that Jason Zweig did with Peter Bernstein,
Yep.
and he
Wow,
he emphasized,
that was old.
yeah, yeah, it's like '04 or something, I think,
Yep.
and Bernstein died in '09, and at
Yep.
the age of 90. And anyway, it reminded me of you. And I came across this in the past, I don't know, 3, 4 days. Um, well, to be honest, I came across it in the past 3, 4 months, and the tab has been open on my computer all that time.
I know the
So,
drill.
yeah. So I finally read it, like 2 days ago or whatever. And I was like, oh, this reminds me of you guys, because I knew we were going to be talking to you. Because the emphasis, he said, maximizing returns is okay if you know that the drawdowns aren't going to kill you. And
Yep.
I don't know. I just thought that sort of reminded me of you, but it also reminded me, as I thought of you, that it gets hard sometimes for some people to keep clients when they're not like roar. The returns aren't roaring along with like you know um, the Mag 7 or in
Yeah.
2021, early 2021 when ARC fund was peaking and all that, people kind of, hey, why aren't we participating in this? So um, I think it's kind of a good question to say, how do you hang on to clients? I mean,
Yeah. It's a fair question. A lot to unpack there. Let me first say before I forget, thank you. I think, Peter probably wrote one of the best books on risk management in the industry. I think that was
absolutely.
back in the early 2000s. And Jason, I think, is one of the best writers and probably one of the most, independent thinkers in the financial journalism industry.
Yeah.
So yeah, fortunate to have gotten to know him over the years as well. I would say, the short answer is what I just mentioned previously, and it goes back to making sure we are really working with the right investors. We've turned away investors that we didn't think were a good fit or saw a mismatch philosophically that were really large accounts. And so we'd rather work with a smaller investor knowing that, they're sleeping well at night because they trust us and have known us over the years. But I think it has been, probably one of the longest stretches of value underperformance in history, right? We're coming up on, I mean, there's been a little bit back and forth in recent years, but I mean, more or less since the financial crisis, if you've done anything outside of US tech, you've diminished returns. So whether you invested abroad or whether you invested in value or basically any other sector of the market. Um, I was reading something by Morningstar recently, and I'll have to go back then. I don't remember the stats off the head, but it was, they had stats around the amount of assets and the number of funds in the value and growth categories over the last decades. And you saw the same thing in the late 90s, right? Like there's that famous letter from Julian Robertson, like literally almost to the day of the peak in 99, 2000 when Tiger folded, just basically saying, right, like you just had record numbers of value managers just throwing in the towel, closing up shop, either because they were completely frustrated or because their clients were completely frustrated. So I would say two things. One, we've been fortunate, extremely fortunate to have a really just this a wonderful investor base. We've never really had a business development effort here. And so most of the investors that we work with have come to us because they've been, in most cases, have seen our work, following our work, reading our work for years and years and years. And then at some point, something changes in their environment or their world or their situation where they're ready to call and learn more. And we pick up the phone and it's like, we've known them already for 5 years, or they feel like they've known us already for 5, 10 years. So it's a really easy, you can see when that's a good fit. And those clients typically, I use the example, in March 20, I think the only time my phone rang was there were two or three of our larger investors that I knew had a good bit of cash on the sidelines, and they were calling to ask if it was time to send in more money, right? So it's few and far between where we get calls from investors worried about what we're doing, worried about what's happening in the markets. It does happen, right? But um, it's one. I think client base is one of the most underappreciated competitive advantages an investor can have in the industry. And then two, we've been fortunate. I wouldn't say, so, well, let me say this. We don't benchmark against the S&P because we run a global portfolio. That being said, we've generally kept pace with the S&P over the last decade or so. Even with a value tilt, even with not owning the Mag 7, even with having half the portfolio outside of the US, where anything outside of the US is underperformed. So we're well ahead of global equity benchmarks and any value benchmark, because I think there's a big difference between types of value investors, right? You've got value investors that are just buying, crappy commodity companies that, you're depending upon catching the cycle right? Because over time, almost every company in the commodity sector has destroyed capital. You've got, value investors that are just buying low PE stocks like banks or other cyclical businesses. Um, and I don't, like I said at the outset, we're just looking for mispriced securities. So we're not focused on any particular sector. A lot of times we're looking for situations that aren't dependent upon the market going up or value outperforming growth. We're looking for specific catalysts. So we have been fortunate to hold up, I think, better than most value managers over the last decade or so. The way what I like to say is, we've kept up with, arguably the strongest headwinds to value investors in history for the last decade. Um, I'm looking forward to seeing what we can do when and if those headwinds actually ever turn into tailwinds again.
All right, so I want to focus on the words mispriced securities because that's not just mispriced stocks, right? That's there. What other
Our, our
securities might we
focus
talk about?
Our focus is predominantly equities. Historically, we've managed money. The only other example I would throw out there, historically, we've managed money for family offices, right? High net worth families, for the most part, taxable investors in high tax brackets. So there have been times over the last, well, in the 20 years that I've been at Broyhill, where we've seen really interesting opportunities in the closed-end fund markets, where closed-end funds. So I don't know, I don't know if we want to get into the definition there for your readers, Dan, but
Sure.
they
Yep.
they trade like stocks, right? So when
Yep.
you buy an open-ended mutual fund, like a Vanguard fund, let's say you put $1,000 into that fund, that transaction happens at the end of the day after the market close. So Vanguard knows the value of the fund and they issue shares based on the exact value of the fund at market close and the price of all of those underlying securities. And in theory, right, funds can take in money and they can lose money over time. You
Right.
mentioned ARK earlier, right? Like ARK surged in 2021. I think in 2020 and 21. In one of those years alone, they took in like over $10 billion. So mutual funds can grow and raise assets, and they can shrink and lose assets. Open-ended funds,
Hmm.
closed-end funds launch with a defined pool of capital, and they trade like a stock, but it's actually you could have a S&P 500 closed-end fund, and the difference being it's not issuing shares like an open-end fund does when investors want to buy the fund.
Hmm.
Investors can just say, okay, I see this closed-end fund trading for $10 today. I want to buy some. And if you've got a lot of investors that are trying to buy it at the same time, that may push up the price of the fund from 10 to 11,
Hmm.
even though the value of the securities in the fund may not have changed. And
Right.
so you can get this discrepancy between the price of the fund and the value of the securities that the fund actually holds.
Right.
And because that market is geared towards retail investors, you see major swings in sentiment. And so, there have been times over the last, well, and COVID was the most recent. Like during COVID in March 2020, we were buying, you know, closed-end municipal bond funds that were literally trading at 20 to 25% discounts to their net asset value,
Wow.
right? And so the underlying bonds that the funds held were worth 25% more than what we were buying them for at that price of the fund. And then when
Hmm.
things settle down, right, that discount just closes and you're able to earn not only the income that the bonds are throwing off, but that spread as it closes. But for the most part today, we are almost exclusively focused on public equity markets.
Okay. Um, I have to let the reader in behind the curtain here because I can't resist. The moment is too perfect for
Uh,
it. Um, well, you and I are talking like maybe a couple hours before the Fed is going to tell us how much they're going to cut interest rates, which they will have done by the time our listeners is hearing the sound of our voices. Uh, what I want to know is, do you care at all? Before we talk more about equities, I want to talk more about that, and maybe some specific names if you got them lately. But I want to get this macro thing out of the way.
Yeah. Do you care
Good.
about
Do
interest
Let's
do
do
rates?
that.
Because which I will be writing about momentarily here for our daily newsletter. Yeah.
Yeah, there you go.
Um, as much as I would like to tell you guys that, we've got a crystal ball pointing to 25 or 50 basis points today, it seems like a coin toss to us.
Hmm.
And I would even say, you know, I think Buffett made this quote a while ago, and this is exactly how I feel today. Even if I knew the answer to that,
Hmm.
I don't know that I think the market's reaction is a coin toss.
Yep.
It was just back and forth with the team this morning, right? And I think the consensus is if they go 25, the market's going to be worried that's not enough and they're too far behind the curve and you get a big sell off. If they go 50, markets are going to cheer that, thinking it's coast is clear, we're back to right, go Fed, printing money, and markets rip.
Right.
What's interesting though is if you look back at the last several decades of cutting cycles, historically, when the Fed starts with 50, it has not been a good sign. The Fed started with 50 in 99, 2000, and they started with 50 in '07, '08, and they started with 50 in 2020. And, I think the message there is, you know, what do they know that we don't? Are things a lot worse than we're currently seeing on the surface in terms of the economy? So who knows? And the other thing, right? The other thing, the point is historically the beginning of a rate cut cycle is totally intuitive, but if a rate cut is followed by a recession, markets are lower following the rate cut. If the rate cut is not followed by a recession, markets are higher. So, I guess bottom line, recessions are bad for markets. If that's a breaking news for your audience here today, but we
Yeah.
don't we don't necessarily pay a whole lot of attention of what the Fed is going to do. I think the bigger piece, at least in the short term, is kind of what it means for sentiment. Um,
Right.
and we gave a presentation recently that talked to that in terms of the record crowding in the markets, the
Mm.
record herding, record concentration at the top of the market. So I would say, you asked about macro. you I think my favorite line is, we worry top down, but we invest bottom up, right?
Yep.
So like we're looking at individual securities and we're looking for mispriced assets as we talked about, but you can't ignore what's going on, right, in the rest of the world. That being said, I don't think you can let that, wag the tail of the dog
Yeah, you
either.
mentioned.
So the presentation you just referred to, is that the one called Equal Opportunities on your website?
That is. Have you seen that already?
I
I
enjoyed
didn't
it. Yeah.
realize it went out yet.
Yeah.
Yeah.
Yeah. I liked it.
Yeah, you mentioned mispriced
Um,
securities. You also mentioned capital preservation early on. Um, what does that mean to you, and what would kind of keep you up at night uh, at this point? When, you know, macro things, maybe not, but or maybe I don't know. What's on your mind there?
I want to pile
Yeah.
onto that question too. I'm going to pile onto that
Okay.
question and say, Chris Bubala, how the hell are equities good for capital preservation?
Fair
Right?
enough. Fair enough. So I think the first answer. Let me take that in reverse order, and this goes back to the presentation you just mentioned, Dan.
Mhm.
So you've seen these numbers, but the way we think about it, um, we looked at the last 65 years where the S&P 500 has outperformed to this extent that we saw. And so the first time we gave this presentation was back in June, July, and June was like this, I think, the blow off top for momentum stocks. And so we
Mhm.
went back and looked at markets then over the last 65 years and basically saw that, well, one, there's been a few times in history where markets have been this concentrated. 1929, 1999, today, and then you had brief spikes in the mid 60s and mid 70s where markets
Oof.
were extremely concentrated. Every one of those corresponded with important inflection points. Um,
Mm.
the other thing was, in every one of those instances, you saw massive bifurcation in the markets where the top of the market looked really expensive, but everything else was generally reasonably priced or even cheap. And there were absolutely pockets of value. So go back to, we've been using this analogy for a while now, but if you go back to 99, 2000, when the market topped, um, S&P went on, S&P went on to lose, roughly half of its value. NASDAQ lost a lot more than that. But the average stock in the market, or the median stock, was actually up 25% over the following 2 years from the market peak. Because as we're seeing today, the average stock, nobody was interested in, right? Like back then, it was a different set of securities. In the 70s, it was a different set of securities. Today, it's, well, actually a handful of the same securities from the 90s, but everybody's obsessed with what's going on with the FANGs or the Mag 7 or whatever, whatever acronym we've made up as the composition of that basket changes. And people are just completely ignoring the other 493 stocks in the S&P 500, which I think are very attractively priced. Or at least, I wouldn't say overall, but where I would say we are finding things attractively priced. And then even more so, um, looking at things outside of the S&P 500, right? Like the US has outperformed the rest of the world because it's been tech, it's a very tech heavy index, and US tech has been driving the US markets higher. International markets, a lot of international markets are very cheap. And we're finding a lot of securities where, comparable businesses in the US trade at 2x the valuation of very similar businesses selling the same products in the same markets, that are just based outside of the US. Um, I forgot the first part of that question, Corey. If you want to, I think it was basically what we worry
Yeah,
about.
capital preservation. What's that? What that means to you, and if something were to keep you up at night in that area, what are those things?
Yeah, I mean, generally what keeps me up at night are individual names in the portfolio, because by definition, as value investors, right, we're often buying things with a lot of hair on them, which means we're often buying on the way down, which means we're often wrong before we're right. And so we're scaling into positions as stocks, assuming stocks get cheaper after our initial purchase, which means you look wrong for a while, and so we're constantly doubling back on, are we wrong? And did something really change? Or is this, consistent with what we were thinking? So I would say more often than not, it's an individual name in the book that's keeping me up. Today, I think just the geopolitical environment. Right. I think just, what you're seeing, whether it's Russia, Ukraine, whether what we're seeing in the Middle East, today, whether it's China, Iran, China, Taiwan, and we won't even, I'll resist the urge to get into, the US election cycle. We'll just leave that alone, hopefully today. But I just, there's, that's the scariest thing to me. I don't remember another time in my career where the world seemed like it was in such a precarious position where, and people forget, right? Like sometimes it's just, you don't know what little stone that gets tossed in the pond, like what ripple from that stone is going to cause, the dominoes to start falling. It's often something minor or a mistake or an oversight or a policy blunder, or just right that escalates quickly and then makes it hard for, leadership to walk away or talk down, and things just, things can spiral out of control really quickly. And I'm not sure we've got the leadership in this. I mean, in a lot of the largest economies today, let alone this country, where they've got the discipline or even care to think about this stuff, as opposed to just worrying about, you know, ESG related issues in our individual economies.
Yeah, no, I'm with you there. The leadership seems lacking everywhere, or
Well, I'll
yeah,
go further. I'll go further. It's almost like some, leaders in some economies, and we don't need to name names, or I agree, get into the election cycle or anything, but it's almost like some political leaders sit down and say, we got a good thing going here. How can we really screw it up the worst? What can we do? What do people want to hear that would be the absolute worst idea that has never worked in history and proven time and time? You know what I'm saying? It's just I feel like at this point, um, and okay, I'm going to break the rule I just made. Like for example, when Kamala Harris talks about wanting to fight price gouging, so that's price controls. And speaking of books I read recently, I forget the full title, but I think it's 40 Centuries of Wage and Price Controls: How Not to Fight Inflation was a book I read
Yeah.
recently. And 40 centuries, that's a pretty good sample, you know, and it never worked once. So
Right.
the fact that bad ideas can just live on and on and on. It's like professors who have tenure, and the bad ideas don't get them fired. Um, and they just come back. It's I have to laugh at it because I don't want to cry, but
Yeah.
I agree with all of this. And yet, Chris, like people like me complain about this stuff endlessly and wring our hands about the market endlessly. But I was born in like 1961, and I started working actually when I was like 10 years old. But if I had just put everything I could into the stock market as soon as I started
Yeah.
earning money, we might not be talking because I'd be on a yacht somewhere.
Right.
You know what
Yeah.
I'm saying? So,
I think it's funny, Dan. I tell people, right? I started the conversation by saying people pay us to worry for them,
yep,
and unfortunately, that's just how I've been programmed naturally. I think a lot of it is just
yeah,
upbringing and the time of your upbringing and what people have gone through, and so I am a natural worrier.
yep,
Um, that being said, so you know, we were talking to a prospective investor at some point in the last year, and he asked me the question, you know, given everything you're talking about, should I just wait? Like, why, to your point, right? Like, if you're worried about capital preservation, why, why don't I just wait for markets to come back?
yeah,
Um, and then, right. And then invest at much cheaper levels. And I would say a couple things. One, I don't think that's the right answer, right? Like, I don't think the right answer today is to avoid stocks. I think the right answer is to avoid the Vanguard 500 mutual funds or managers that basically just hide behind the S&P 500. It's to
yeah,
avoid passive indices because there is value out there. And then the other thing I said to him was, listen, you know, per our earlier conversation on being paid to worry, there's probably been, I can probably count on one, maybe two hands how many times since I've been at Broyhill where in speaking to a prospective investor, if I were asked that question, I would have said, you need to give it all to us right now. I've never been more bullish. I think markets are priced to be up, compound at 20% annually for the next 5 years. I can probably count on one hand how
mm,
many times I've said, give it all to us. We're going to put it all to work. And to your point, over those 20 years, you've done all right investing in S&P 500. So bottom line, like, listen, I'm paid to worry.
mhm,
Um, I think I'm a better stock picker. We're better stock pickers than we are market timers. And so
right,
even though we're worried and, and Dan, I know you've followed us and read our work and, um, there's definitely, you can see that worry come through in our writing quarter after quarter after quarter, year after year. But that doesn't mean we're not taking risk and trying to earn, you know, solid risk adjusted returns.
right,
It just means we're being very careful and making sure that we're being compensated for the risks we're taking. So I don't think
yeah,
it's, and that goes back to your, the earlier question on how does, investing in stocks and capital preservation, how do those two comments jive? And I think that's
yeah.
really it.
Yeah, some of what you said reminded me when you said, the answer is not to sort of wait and stay in cash. Reminded me of a book by Peter Cundill, famous value guy, called, I think the title was "There's Always Something to Do." Right?
Yeah.
There, something somewhere in the world is cheap, and your job is to find it. Cheap and decent, not just a cheap piece of garbage, right? Because they're everywhere.
Yep.
um,
Yep.
yeah, yeah,
Yeah. No, I love that. We talk about all the macro worries a lot, but then you remember, or you try to remind people, like, yes, but what else are you going to do? What's the other game in
Yeah.
town?
right, yeah,
Um, I don't know. I haven't found a better one.
right. Right. I want to emphasize, though, this point. I want to make this point about capital preservation for our listener really as explicit as possible. It sounded to me like the answer was um, basically margin of safety, right? Because the securities you're looking for are mispriced, and there is a margin of safety there. Um, you can look at equities and say, yeah, this is suitable for long term, admittedly long term capital preservation, because our business is to know the value of things and to buy it when we can get it below that value. And yeah, and a really
Yeah.
great illustration being the closed end funds you mentioned. Um,
Yeah, and I mean, so that's absolutely one component of it, and I would say that's
mhm,
the really the first pillar of our investment philosophy is right, make sure we're buying with a margin of safety because valuation is an imprecise science, and so
mhm,
right, like any valuation we put out there, we're probably going to be wrong, but so we want to make sure we're buying so far below that number that we've got room to be wrong. The other
yep,
thing that I think is just, the industry does a great job of completely bastardizing is trying to quantify risk. I think, risk management to us is just common sense. It's
yeah,
right. So like
couldn't
today,
agree more.
and it was the same thing in 2021. We were really worried about what we were seeing in the markets, signs of excess speculation ever, signs of excess leverage in the system. And, especially today, when I go back to the earlier comments of the bifurcation between the haves and have nots in the market, we started about 12 months ago. We had a good bit of turnover in the portfolio, and we wound up after making a handful of trades, and this was bottom up, but you know we took defensive sectors of the market up to almost two-thirds of the portfolio.
Mhm,
That's relative to global equity benchmarks or the S&P 500. That's probably, I don't know, it's probably 3, 4x the weighting of indexes. And what's
yeah,
interesting there is typically that's what you want to own when you're worried about risk to the economy. You want to own stuff that is less cyclical.
mhm,
Um, in theory, you should be paying up for that stuff right now.
right,
But
yeah,
because nobody cares about it and everybody's just more fascinated by chasing the Nvidia and the Mag 7, uh, defensive sectors of the market were about as oversold as they had ever been historically and
mhm,
about as undervalued as they had ever been historically. That's, they've rallied a bit this year. What's interesting is like I think utilities are actually outperforming tech this year,
yeah, yeah,
believe it or
yeah,
not.
yep,
Um, and so it's common sense. It's looking for opportunity. It's buying with a margin of safety, and it's also thinking about it's being creative with regards to portfolio construction. So one of the other ways we differentiate ourselves from I think other value investors in the market is we look for more special situation, event driven type of situations.
mhm,
Um, Today, for example, there's a number of, well, really for the last few years with this administration's kind of antitrust policy, you know, a lot of ARBs aren't comfortable stepping in front of that political risk, which
mhm,
means the spreads for, announced merger acquisitions, some of them are about as wide as we've ever seen. Generally, like merger arb, you think of as almost like a cash/fixed income type expected return with a bit more
right,
or a good bit more volatility if you get some wrong.
mhm,
Um, you know, we're seeing spreads that are just, I mean, one of them was, that are basically discounting like 20 to 40% odds of deals getting done when historically 90% of announced deals have closed.
mhm, yeah,
And those are nice, right? Especially in times like this, where if the market did fall, if you've got a portion of the book that's invested in situations where the only thing that matters is the ruling, it doesn't matter if the markets are up or down. Um, we think that makes a whole lot of sense in terms of thinking about how to preserve capital in the market.
yeah. This I used to think more about merger arb than I do, but like we recommended in our newsletter Kellanova, and we said it
Yep.
was worth, whatever, almost exactly what they're paying for it, basically, like 83.50, I think it is. And it's like
Good
80.
call.
Yeah, I mean it's like 80.
Yeah, Dan. When
Um,
I saw that, by the way, I said,
you know,
"Were
it's
they
just
reading Extreme Value when they made this deal?"
yeah, that's right. They were the buyers were reading
Yeah,
extreme value. They were
you're
like,
spot on
yeah,
there. Yeah.
Yeah.
Dan's right. Yeah. Of course, that was really that's a Mike Barrett pick, and he's runs our valuation model. And he's that guy. He's forgotten more about valuation than I will ever know. Finding him was like, maybe more than 10 years ago now. Um,
Yeah.
was it was gold. It was amazing. But yeah, so I noticed that too. Just in that one
Yeah.
example. Um, so you have some of those in the portfolio.
We do not as much as I would like.
Mm,
In 21, 22, that was probably the biggest component of the portfolio. We had over 20% of the portfolio invested in one situation where we felt extremely confident. We only, and for what it's worth, we only go that big. So the way we come at merger arb is, we first try to underwrite the security via our typical process.
hmm
And we're typically looking to buy 3 to 5 year doubles, right? So round numbers, if you pencil that out, we're looking for 15 to 25% IRRs. Um, if we can underwrite a business where we still think it's a 3 to 5 year double if the deal falls through, and if the deal goes through, we make 20% plus in 6 to 12 months, we should be right. Those types of situations don't come along often. I think I can think of two or three in my career. And when we see that, we will go really heavy because it's hard to see, right? Like if the deal closes, we make money in the short term. If it breaks, it's a business we think is worth 2x anyway
hmm
in 3 to 5 years. So we're comfortable holding through a break. And that's different than most merger arb investors where as soon as the deal's off, right, investors are going to puke up the stock. And that's where you see
Do,
selling pressure.
do you have an example of one of those two or three that you mentioned that you could
Yeah.
provide?
So the most recent was Microsoft's acquisition of Activision,
Yeah.
which Microsoft was buying Activision for $95 per share in cash. There was roughly a $3 in breakup fee, so it was almost that we would have gotten. And there was a point in time within the last 6 to 12 months that deal was on the table where you could have bought the shares for $75.
hmm
Um, the market was basically, you had the FTC trying to block it, and then you had the UK's CMA trying to block it. Um, we were just, we had been looking at the industry for probably the last 3 to 5 years, had not gotten involved until that point. Microsoft bid for Activision because the company had some corporate governance issues and the stock was probably halved or more when Microsoft stepped in. So we were sniffing around at that time. And then we just stepped in and said, this is if the deal closes, we'll take $95. If it doesn't, we think it's $150 stock in 3 to 5 years. And so, and then coincidentally, the only other time we had been that big was an almost identical situation. So the issue with Microsoft Activision was you had, distribution buying content. So it was vertical integration. Historically, at least in the US, I don't think we've ever successfully blocked a vertical merger, right? The larger issues are horizontal, right? Where you've got competitors buying another competitor where you're eliminating competition. Vertical, right? Microsoft owned Xbox and they were buying Activision, which makes some of the games for Xbox. Um, a very similar situation about 10 years, maybe not 10 years prior, was AT&T's purchase of Time Warner, which I think, and this is from memory, maybe the deal price was like 105 or something along those lines. It was the same thing, right? AT&T is a distributor of cable channels. They were buying content, and this was actually it was right around a decade ago because this was right at the beginning of Trump's first administration in 16, and he was blasting CNN, which Time Warner owns, and he was very vocal about wanting to block the deal. And just in both cases, like the law just didn't support it. And so, and we were able to underwrite the businesses where we thought we had a lot more value, even if the deal closed. So I wish we can find one of those today. We've got a handful of much smaller situations where, we don't have quite the conviction, but I still think the risk reward's tilted in our favor.
That was my next question. Just want to make sure you didn't have one of those today. Um, so you mentioned, and I was going to get to this. We have to get to some version of it. You mentioned just doing your normal process in underwriting a security, and I thought maybe the first thing our listener needs to know is why is this guy using an insurance word to talk about analyzing a stock? Underwriting.
Um,
What's he talking about? Who is this guy? Who is this Pavese? What is this?
Underwriting a name is just, the research we do to understand the business, understand the competitive dynamics of the industry, understand the macro backdrop, understand the peers that they're competing with, and then ultimately try to pencil in what we think the business is worth. Um, so our process, we typically pick something up because we're a small team and the first look is geared to trying to reject it as quickly as possible. Um, and so it's either pass or, do we want to spend more time on this? Is it worth spending more time on? And if it's worth spending more time on, what are the three biggest items that we need to focus on? And so, if we decide to continue, we may spend a week, a couple weeks, a couple months, or longer researching the industry, researching the company. And ultimately, where we want to get to is, when I say we're underwriting to a 3 to 5 year double, we're looking at probability weighted returns for every position in the portfolio. So we're not just saying, best case scenario, what do we think this thing is worth? We're saying, okay, if this happened, we think the business, right, if it plays out like this, we think the business will be worth this much. If we're off base and actually it unfolds more like this, we think the business is worth this much. And we'll have an upside case and a downside case at a minimum for every name in the book. Sometimes we've got a lot more scenarios than that. And then we probability weight every one of them. So that's absolutely more art than science.
Right. Yeah.
But we're saying, and we've got data that shows, historically, we've been right about 60% of the time. And so our base rate, our starting point for underwriting businesses is 60%, to the upside, 40% to the downside. And then we just constantly tweak those numbers, right? So with every new piece of information we get, we're looking at, did that change what we think in terms of what the business is ultimately worth? Or did that change what we think about the likelihood that this is going to happen or that's going to happen? And so we're constantly tweaking those numbers throughout the day, throughout the quarter as new information comes in, and we're ranking names on probability weighted expected return, and sizing them accordingly.
I have a question about the getting the new information and changing, an intrinsic value estimate. Um, let's see. I'm not even sure how to ask the question, but I've thought for some, as a value investor, you learn that like the market price changes a lot more and a lot faster than the value.
Yeah.
And it makes me wonder, as I hear you talk about this, I wonder, if I were sitting over your shoulder for years and years, like how many times did a quarterly report really change things for you so much? What's the likelihood of any given quarterly
Yeah.
having a real big change?
Yeah. It's so good question. We're rarely forecasting quarter to quarter. We're generally, as I said, looking out 3 to 5 years. And so when what we're doing is thinking about, okay, in a normalized operating environment, what do we think this business should earn? And what do we think that those earnings are worth? Um, so we do make, so it's interesting. I'll give you another piece of data. Um, so the software we use for this process, they've got 15 years of data across dozens of managers and probably millions of trades. And they looked at the data they had on file historically to see if they can find any particular variables that were predictive of which managers would perform best, right?
Mm.
So what variables, if any, were predictive of outperformance or alpha generation? The only thing they found, the single factor, was the frequency of manager updates. And when you think about that, it doesn't make sense intuitively. But if you go back, I'm guessing you've probably read, if you dust it off, Dan, Tetlock's Super Forecasters.
Oh yeah. Yes.
So that was entirely consistent with what they found, in
Right.
that the
That's right.
best forecasters tweaked their assumptions at the margin with incremental data pieces. So we're not talking about, we thought this thing was going to grow 10% annually, and the most recent quarter comes in at 2, so we take our numbers down to 2. But if we were expecting 10 and it came in at 2, we're going to say, did something change there, or is it just quarter to quarter noise? Or even did something as similar. I'll give you an example. Philip Morris has been our largest position for some time. The stock's done
Mhm.
very well this year on the heels and excitement for Zyn nicotine pouches in the US.
Mhm.
At the beginning of this year, they started talking about shortages. That makes it pretty obvious that, right, our upside scenario, like we could start nudging our upside scenarios, and the likelihood that they're going to sell more Zyn than we had thought, like they're basically selling everything they can make.
Mhm.
And guidance comes up every single quarter. And so anytime we see a data point like that, um, right, we're either tweaking our assumptions for volume growth over time. We're thinking about how market share might shift, but also if our upside scenario priced in faster growth in the U.S. markets, we may start putting a little bit more weight on that, right? And then
Right.
as those probabilities shift, your expected value shift for every name as well.
Oh, that's a good answer. Thank you for that. Um, it's actually we've been talking like the time has flown by. I have to say, which is great.
Yeah,
Very,
yeah. I
it's
feel
it's
it more
always a pleasure to
educated right
talk
now.
with you. We come to the moment when I ask the final question, which is the same for every guest, no matter what the topic, even if it's non-financial topic. And if you've already said the answer, by all means, please feel free to repeat it. Um, the
Okay.
final question is, um, if you could just leave our listeners with a single thought today, what would you like that to be?
Yeah, that's easy, and only because we just did our investor call and and we finished that call encouraging investors to just remember one thing. Um, and I think it's just you know, along the lines of what we discussed earlier in terms of, you know, if you're worried about markets today, I don't think the answer is to avoid stocks altogether. I think the answer is to avoid passive indices, and really the best way to manage risk in the crowded momentum driven benchmarks, and let me clarify, momentum driven US benchmarks, is to
Mm-hmm.
simply rebalance away from what's working towards what's not. So rebalance towards what's expensive and towards what's cheaper, because what's cheaper, um, like I said, the bottom of the market is about as cheap as it's been historically, and that's typically been a very good signal for active value managers on a 1, 3, and 5 year basis looking forward.
Hey, listen, Chris, it's always a pleasure to talk with you, and it was a great pleasure this time as well. And let's do it. Let's do it again sooner than every few years.
Happy to, Dan. Thanks for having us.
You bet.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.